This is Jason Barber, CEO and founder of Holistic Planning. I'm excited to spend some time with you today to talk about qualified charitable distributions, also known as QCDs, and whether that may or may not be appropriate for you or a family member and how that can benefit you and save you money in the long run. Let's first start out by talking about what is a QCD. Like I mentioned a second ago, QCD is short for Qualified Charitable Distribution. Only some people are eligible to do a QCD. First and foremost, you have to be 70 and a half years old on the day that you do the distribution. That's really important to understand also that that's not the year that you turn 70 and a half, but rather the day that you turn 70 and a half to the day. You are not allowed to do a QCD until you are exactly 70 and a half years old. It used to be, not that long ago, prior to the Secure Act passing, that required minimum distributions started the year that you turned 70 and a half. That has since changed now to where the required minimum distribution starts when you turn 72, and now I believe it's 73 and potentially 75, depending on what year you were born. The required minimum distribution, for those that are not familiar, I'm sure we'll have other videos that will go into a masterclass on required minimum distributions, but generally speaking, that's the age when IRS is going to require that you start to distribute money from your pre-tax retirement account and start to pay income taxes on that money. So for those of us that have money, pre-tax money that's never been taxed before, that's in a traditional IRA account or possibly a 401k account or a 403b or other qualified retirement plan, the required minimum distribution is sort of the end date where the retirement, where the IRS rather, is ready to start getting paid taxes on that money. Generally speaking, it starts at around, like I said, around the age of 73, potentially 75, and roughly around 4.5% of the balance of your account. So the reason why a qualified charitable distribution can be beneficial is it can help you direct some of that money that otherwise would have been required to be distributed from your IRA or 401k plan, and can instead direct that money to a charitable cause that you care about and helps you to not have to pay income taxes on that money that you're distributing from your IRA. So it's kind of like a backwards way or a backdoor way of getting a tax deduction. The reason why this is also beneficial is that many of us, not all of us, but many of us, because of the way the tax brackets work, are taking a standard tax deduction rather than an itemized tax deduction. So the way this can benefit you is that, let's just use an example. If family is contributing, let's just say to their local church, they give $500 a month to their local church, which is very, very respectable, but also and very common. So that would be $6,000 a year that they're giving. For the most likely, unless they have substantial medical bills or substantial property taxes and mortgage interest, they're probably not itemizing their tax return. So if a family was to say, hey, we're going to give $6,000 to the church, they're not necessarily benefiting income tax-wise to make that contribution. And so that makes it less advantageous to them, and so what sometimes can happen is people can have a required minimum distribution that's coming out of their IRA that they have to pay income taxes on. Let's say if I had $1 million in a traditional IRA account and I'm 73 years old, I could have potentially up to maybe $45,000 or $50,000 that I'm required to distribute from that IRA, and I'm required to pay income taxes on that money. But let's say that I turned around and then I gave $6,000 of that money, whether it was those dollars or other dollars doesn't particularly matter, but $6,000 of that money ends up going to the church that year. Well, I paid taxes on this money when it comes out of the IRA, but then I gave some of it to the church if I just sent it directly from my bank account, for example. and I don't end up getting a tax deduction for that. So that's not ideal. And so the qualified charitable distribution exists to allow us to say, hey, instead of taking money directly from my traditional IRA account, I'm going to instead defer or direct rather some of that money to go straight from the custodian, right? Pershing, Charles Schwab, Fidelity, et cetera. I'm going to have that money go straight from the custodian directly to the charity rather than coming directly to the owner of that IRA account. And if you do it that way, there's no income taxes on that money that you give directly to the charity. But it also satisfies your required distribution. So that's really important to understand. It satisfies your required distribution, and you also don't have to pay income taxes on that money. So those are some of the biggest reasons, from a tax standpoint or direct federal income tax standpoint, that a qualified charitable distribution can be beneficial. There are some other ways that QCDs are also beneficial that are maybe a little bit harder to understand and kind of get into the weeds a little bit more, but we'll try to go into that here. One of the ways that QCDs also benefit you is understanding that it could potentially benefit you by paying less on your Medicare taxes and Medicare premiums, rather. So there's a policy that Medicare has that's called IRMA, IRMAA, stands for Income Related Monthly Adjustment Amount. That IRMA cost is essentially a surcharge that you and potentially your spouse may end up having to pay if your income is too high in a year that you're on Medicare. IRMA can actually affect you as early as age 63. It's important to understand that you go on Medicare the year that you turn 65, but when you turn 65, IRMA is looking at the income that you made 2 years in arrears. So when the year that you turn 63, that's the year that you could potentially be impacted by this. So naturally, once you're at required minimum distribution age, 73, 74, 75, you're most likely on Medicare as well. And you also have to understand that during that period of time, if you have a very large required minimum distribution, if you say, hey, I've got pensions, I've got Social Security, I've got real estate income, I've got dividends and interest off of my investments, et cetera, and then I also have, $50,000 or $100,000 or $200,000 required minimum distribution because I've got a lot of money tied up in a large amount of pre-tax money that I now have to distribute, that can potentially cause you to not only have to pay income taxes on that IRA distribution, but could also have to pay higher Medicare premiums for you and potentially your spouse. And so that's what I would like to call a hidden tax, because those Medicare premiums are taxes that don't show up on your 1040 when you do your income taxes at the end of the year. But rather what happens is that at the beginning of every year, you're going to get a letter in the mail from Social Security that spells out how much additional money they're going to be taking out of your Social Security check to pay for that additional Medicare tax. So possibly, in my opinion, one of the most egregious taxes that's out there. I just really don't care for it. But the QCD can help solve that problem, because if we can, instead of taking that large amount of money out of that retirement account, if we can instead, for example, direct that money to a charity of our choice, that could potentially save us a lot of money in federal taxes, and could potentially also save us and our spouse a lot of money in Medicare premiums as well. Additionally, another thing to understand about QCDs is that, you are, like we talked about at the beginning of this video, you're eligible to make a QCD as soon as age 70 and a half. So you don't actually have to be at required minimum distribution age in order to take advantage of this, but that can also help reduce your future required minimum distributions if, starting at age 70 and a half, you start using your qualified charitable distributions for any kind of charitable giving that you or your spouse might be inclined to do. Also, another important thing to understand is there is a maximum annual amount per IRA owner of $100,000. So you're able to give up to $100,000 per year per person to the charity of your choice. And so you can do that every single year if you would like to, of course. So you're able to do up to that amount of money. So you're not limited by the required minimum distribution or anything like that. So that's additional benefits there that can come from that. One other way that you can save money on taxes that's kind of, again, sort of a little bit harder to understand and a little bit more hidden. And again, this is another one of the videos that we'll have a masterclass on to go into greater detail here in the very near future. But that's Social Security taxation. So it's very important to understand that Social Security, if your income is low enough, and by income, I mean other income. If your other income besides Social Security is low enough, your Social Security is potentially income tax free. However, as your other income, and by other income, let's just call that interest, dividends, IRA distributions, real estate income, et cetera, as your other income starts to go up, then your Social Security becomes more taxed, kind of progressively taxed at a higher level, or more of it becomes taxable rather, as your income rises. So by that, with that understanding, if we can reduce the amount of money that's coming from our IRA accounts by using QCDs, that could potentially save us taxes, basically double taxes, because it can reduce the amount of taxes that we have to pay by not having it coming out of the IRA, or rather giving it to the charity. But it can also help us if we have to pay less taxes on our Social Security. So potentially you could end up finding yourself almost having a double tax savings in that fashion. And in some cases, we've seen some people choose to do qualified charitable distributions where they may give $10,000 and potentially save as much as $2,000 of income taxes by doing that, because they don't pay taxes on the $10,000, and it also benefits them by not paying taxes on their Social Security. And so you could potentially find yourself saving as much as 20%, even in retirement years, where you could look at it and you could say, hey, but I'm in the 10 or 12% tax bracket. Why is it saving me 20% taxes if I'm in the 10% tax bracket? And the answer is, I'm paying less taxes on my Social Security, and I'm not paying that 10% tax on the money coming out of the IRA. So it ends up potentially saving you as much as 20 or maybe even a little bit more income taxes to do things that way as well. One other really important thing to understand about qualified charitable distributions is the tax reporting when you do this. So let's say that I had a required minimum distribution of $50,000, but I took $25,000 of that and I sent that directly to a charity of my choosing. The custodian, generally speaking, when they send out their 1099, they typically are going to just report that $50,000 was distributed from the IRA. They usually are not going to, report that, well, only 25 was taxable and 25 wasn't taxable. So you need to make sure that your tax advisor or your tax preparer understands very clearly that half of that in that example was given as a QCD, so that you don't end up paying taxes twice on that money, which would be the worst thing that could possibly happen. That's one of the things that having a independent fee-only advisor like Holistic Planning can really help with, is in preparing and consulting with your CPA to make sure that we are not having errors like that take place, and having us review in advance and after the fact to make sure that there was no mistakes that were made.